Good afternoon. Buenas tardes. Welcome to our webinar this afternoon, our first part of the two-part training series on accounting for construction companies. And we have Luis Cartagena, who is going to be your presenter today. This is Victoria Beal with the Ohio LTAP Center, and we are so happy to be partnering with the Disadvantaged Business Enterprise Supportive Services section at ODOT, and Micah Flanagan, who works in that program, and her colleagues in that office. So we're happy to be able to bring this training to you. Hopefully you've been on one of the other two trainings that were delivered over the last couple weeks. But for those who may not have been, I want to go over just a couple things on the GoToWebinar panel before I turn things over to Luis. First off, for questions, we would ask that you please place those in the question box in the GoToWebinar panel. That's how we're going to accept questions throughout this presentation, and I'll be reading those off to Luis as they come into the question box for his response. Secondly, if you do happen to raise your hand, please know that I'm going to put it back down for you in the attendee portion of the box, because that is not how we're taking questions. So just be aware if you do try to use that function that we're going to redirect you to put your question into the question box. In the handout section of the panel, there are 5 handouts, and we would recommend that you download those at some point in time during the webinar. Luis will be discussing those throughout the presentation. There is a copy of the complete webinar, all the slides there as well. So if you are not able to download those, please don't worry about it, because I will be sending out an email following the webinar with those as attachments, so you'll have them as well. I believe that's all I needed to go over. Luis, are you ready to go?
I sure am. Thank you so much.
Thank you.
Well, good afternoon, everyone. My name is Luis Cartagena, and I'm a certified public accountant. I've been in the accounting industry for over 20 years and recently celebrated my 3-year anniversary since launching Cartagena CPA Consultants. I currently offer services in accounting, financial management, consulting, and tax. And as you could imagine, it's the busy season, and even though the tax deadline has been extended with everything with COVID-19, we are definitely at a busy time. Before I start, I want to definitely take a moment to thank the Ohio Department of Transportation for the opportunity to present these webinars. Some of you may have actually attended the estimating and contract law webinars by my colleagues Joe Lopez and Pat Espinosa. We definitely hope you enjoyed the series as much as we have so far. During today's presentation, please feel free to ask any questions that you have. I don't mind interruptions. While accounting is definitely a fun topic for me, it can be very tedious for others. And so I will also follow up with more information after the presentation via email for those who have additional questions that we may not have gotten a chance to answer during the presentation. At this moment, I'm going to ask Victoria to please put up our first poll question. The question asks, how long have you owned your construction firm? And your first choice is 1 to 3 years. Your second choice being over 3 years. Now, I'll wait a moment for everyone to answer.
They are definitely voting fast and furious on this one. So we are up over 50% voted, and we'd like to reach at least 80%. So if you haven't voted yet, vote quickly so we can keep things moving. Okay, we're there. I'm going to go ahead and close and share the results. We have 41% that said 1 to 3 years and 59% that said over 3 years. So I'm going to hide the poll results, and there you go.
All right, well, thank you. And so I wanted to gauge the audience just to see how many of you may have already been operating for a while and you may be used to some of the terms that I have during the presentation. Additionally, some of you may be getting started and haven't gotten as deep into your accounting system. So I hope that the presentation should have a bit of information for both of you. As you see, when we're talking about construction accounting is a form of project accounting in which the costs are assigned to the specific contract. A separate job is set up in the accounting system for each construction project, and costs are assigned to the project by coding the unique job number as the costs are incurred. You, as the owner, may not necessarily need to understand this part completely, but just understand that whoever you're working with has the ability in an accounting system to set up a job ID and associate that job ID to every check that you receive and every cost that you undertake, so that you can always pull up some kind of a financial statement, not only for the whole organization, but per project. And you can gauge whether you are actually seeing profit on that particular project. Additionally, a number of indirect costs are also charged to construction projects, including the cost of supervision, equipment rentals, support costs, and insurance. Sometimes administrative costs are not charged to a construction project unless this is allowed by the customer. Non-allocable job costs included expenses for unsuccessful bids and proposals, and other administrative costs like marketing, selling, or advertising expenses. These are operational costs. These are not costs that you would associate to the particular project. In accounting, there's a couple of different methods of accounting. Number one, an accounting method is a rule book for reporting income and expenses. Most construction contractors use one accounting method on contracts for work started and completed in the same year. Another method will be utilized for long-term contracts. You can use the cash method of accounting for both short-term and long-term contracts as long as your average annual gross receipts do not exceed $5 million. The Internal Revenue Service considers you a large contractor if your average gross receipts exceed $10 million. Large contractors must use the percentage of completion method of accrual accounting. Whether a method is permissible depends on a number of factors, such as the type of business entity, business activity, level of gross receipts, and existence and absence of factors. One method of accounting is called the cash method. Under the cash method, you recognize income and expenses when money changes hands. You pay taxes on income after deducting those expenses. Many small construction companies use cash accounting for their short-term contracts and an accrual method for long-term contracts. I'll take a moment to talk more about accrual method in a little bit. But per a revenue procedure 2002-28, most small businesses with average annual gross receipts of $10 million or less are allowed to use the cash method of accounting. And most small businesses do. So let's say you are working on a project and you're accounting for your payroll expense. Employee A works 30 hours a week in week 1. They don't collect their payment from you until the end of week 2 for those 30 hours they actually worked in week 1. Under the cash method of accounting, your profit and loss will not show the payroll expense until week 2 when the check was actually cut to the employee. Under the accrual method of accounting, the payroll will be recognized immediately each day the employee completes his shift. So once you actually accrue the payroll expense, you recognize it and an expense immediately under the accrual method. with the cash method, you wouldn't actually recognize the expense for payroll until you actually paid the employee. Which brings us to accrual accounting. If you can't use the cash method, you must choose between the percentage of completion method and the completed contract method to recognize income. Both are methods of accrual accounting in which you recognize income when earned and expenses when incurred. Under the percent of completion method, you recognize income based on the work you complete. Under the completed contract method, you recognize income on the completed job. One thing to highlight is if your business is structured as a C corporation and you have gross receipts in excess of $5 million, you generally are required to use an accrual method of accounting. And to dive a little deeper with accrual accounting, think of bills that you incur during the month of December. So you receive all your billings for materials that you purchased on credit. If you've done that within the month of December on an accrual method of accounting, you're going to recognize that expense immediately when that billing is entered into your accounting system. So at that point, when you run your profit and loss sheet for the year, all of those billings that you entered in December under accrual method would show up as an expense on your profit and loss sheet. Additionally, any expenses that you recognize in December would also be recognized immediately in your profit and loss sheet, which are some tax tips sometimes that allows you to lower your net income. So think about maybe you have additional income available to you at the end of December, and you are looking for a way to not only expand your business but lower your tax burden. You may, if you're using accrual accounting, you may get into a debt for a piece of equipment, and you are now able to recognize that expense within the month of December, right at the end of the year, which allows you to claim less net income. Additional, you have the possibility of deferred income. Under deferred income, which is known as deferred revenue, or unearned income, under accrual accounting, it's money earned for goods and services which you have not yet actually delivered. Because you haven't actually delivered these services, you are now able to enter that into your system as a liability, meaning you take the revenue and the billing creates a liability which takes the money out of your profit, and it is now deferred into the new year until you have actually completed the service. That's a possibility under accrual accounting. At this moment, I'm going to ask Victoria once again to please put up our second poll. The question reads, what is the length of your average contract? A, less than 12 months. B, multi-year.
And they are voting again fast and furious. So we should have a 80% here in no time. If you want to help speed the process along, just vote quickly. Okay, here we go. I'm going to close it out and we'll get you the responses. Less than 12 months is 71% and multi-year is 29%. I'll go ahead and hide that now.
Great. So on average, 71% of you are receiving contracts that are completed within less than 12 months. which means that your accounting should probably and most likely be operating under the completed contract method, which is a form of accrual accounting. The revenue that's recognized under a contract may be based on the completed contract method when it is not possible to determine the percent of completion of a project. As the name implies, this means that the contractor recognizes all of the project revenue and profit when the actual project has been completed. Since revenue and expense recognition only occurs at the end of a project, the timing of the revenue recognition can be both delayed and highly irregular. Given these issues, the method should only be used under the following circumstances: when it is not possible to derive dependable estimates about the percent of completion of a project, when there are inherent hazards that may interfere with completion of a project, and when contracts are of such a short nature that the results reported under the completed contract method and the percentage of completion method would not vary materially. For most businesses who are completing their contracts within the 12 months, you will be recognizing the expenses and the revenue immediately as you complete the project. So here's an example which utilizes a bit of some information that's been out there over the last couple of years with economic disasters such as Hurricane Maria that occurred in Puerto Rico. So in this example, Biggs Homes is building houses for disaster relief due to Hurricane Maria, and is doing so at a great speed that the displaced citizens can move in as soon as possible. Big Homes Inc. management expects that the entire development will be completed in just 2 months. Given the short duration of the project, Big Home elects to use the completed contract method. Accordingly, Big Home compiles $650,000 of costs on its balance sheet over the period of the project, and then bills the customer for the entire $700,000 fee associated with the project, recognizing the $650,000 of expenses, and then recognizing $50,000 in profit. As we asked in the poll question, for most companies that operate on contracts that are less than 12 months, the completed contract method will be how revenue is recognized, as the frequency of your completing projects will be faster. Liabilities on the project will be paid within the same year of the project, and payments should be received within the same year as well. The percentage of completed method is used under which the contractor recognizes revenue by applying the estimated percentage of completion to the total anticipated profit. This approach allows the contractor to recognize revenue and profits at regular intervals over the term of a project. There are some new accounting standards that are going to affect the percent of completion method. It's ASC 606, which went in effect in 2018 for public companies. So C corporations are considered public. And then now in 2019, they are now being recognized for private companies. The core principle of the new revenue recognition model is that an entity would recognize revenue as it transfers goods or services to customers, and the amount reflecting the consideration it expects to receive. So basically what it's saying is that you would recognize the revenue upon completing phases of the project. But in order for that revenue to be recognized, there's 5 steps you should take. So first, you want to identify the contract with the customer. Second, you want to identify the performance obligation in the contract. The performance obligation is defined as a promise in a contract with a customer to transfer a good or service to the customer. Management will need to use significant judgment to distinguish each performance obligation within a contract. Identifying the performance obligation and how they are satisfied will directly affect when revenue is recognized. Step 3, you determine the transaction price. Step 4, you allocate the transaction price to the performance obligation in that contract. And lastly, under step 5, you recognize revenue when the entity satisfies the performance obligation. The method of percent of completion usually allowed for a contractor to bill their customer upon hitting certain percentages in the phases of a multi-year contract. Let's discuss it from that perspective. Under the new revenue recognition model, you will be utilizing the revenue recognition and recognizing it as you complete the certain phase. But part of that means that the actual company can get use of that space. So that's an interesting thing that is going to be affecting revenue recognition for larger companies. Companies such as the 71% that are operating on projects that are completed within 12 months will not be affected by this. As you complete the project, your customer will have the ability to utilize the asset, and so then you would actually recognize the revenue on a normal basis. So some of the requirements for the percentage of completion method is appropriate to use when collection is assured and the entity's accounting system can account for long-term contracts. Thus, going back to when we first discussed the fact that your accounting system should have the ability to allocate a job cost and job revenue to that particular project. The entity's accounting system should also be able to reasonably estimate the profitability. And you should be able to provide a reliable measure of progress towards the completion. There were handouts that were downloaded with the presentation. At this time, if you've actually downloaded the handouts, I'm going to ask you to look at the percent of completion handout, and I will actually pull it up on the screen in a bit here. But when you're doing the accounting for percentage of completion method, you are going to compute gross profit of the completed contract by looking at the contract price and deducting the estimated total cost and getting to your gross profit. Step 2, you're going to complete the percent of completion by looking at the total cost to date divided by the total estimated cost of the contract. In step 3, you're going to compute profit to date, which means you take the number in step 1, multiply it against the number in step 2, and that will be your profit to date. Additionally, in step 4, you will compute gross profit earned for the current year, which means you take the profit to date at the current year, you subtract the profit to date at the beginning of the period, and you will have your current year-to-date gross profit. So as we look at the example, I've included 4 years worth of some numbers estimating how a company that is accounting for long-term contracts would compute their actual profit for the year, which they're going to bring over to their tax return for tax purposes. So let's look at step 1, computing gross profit of the completed contract. So your sales price was $4 million. That's your contract price. Your total estimate was $3 million. And an additional fact is that in year 1, you have incurred $1.5 million to date. So when you start the percent of completion computation, in step 1, compute gross profit of completed contract. Simple enough, you're going to take your sales price, you're going to subtract your total estimate for the project, and you're going to get your estimated gross profit of $1 million. That was your proposal. That's what you submitted as what was this project was going to bring you in revenue and what this project was going to cost you. The second step, computing percentage of completion. You're going to take your total cost to date, which in the facts told us it was 1.5 million. And it's going to be divided against the total estimate. So here in year one, you can see that 50% of the costs have been incurred, which translates into 50% of the actual contract being completed. You're utilizing the cost to determine how far along you've gotten in the project. Under step 3, computing gross profit earned to date, your total contract gross profit was the estimated $1 million that you submitted through your proposal. And as the step 2 computation brings us, we know that 50% has been actually completed on this contract. So under accrual method, you are recognizing the revenue as it's been incurred, which means you're going to recognize gross profit earned to date in year one of $500,000. The reason it's 500 is because this is the start of the new contract. So there wasn't any actual gross profit recognized in a prior year, which is why previously recognized is 0. And so your current year profit will now be 500,000. So now we get into year 2. In year 2, through some change orders, we've actually now upped our total estimate cost of the contract. The contract's still $4 million, but our actual cost has been estimated at $3.2 million. And in total, from total for the full project, you've incurred $2.4 million in costs for year 2, total cost to date. Not just actually year 2, but in total. So now the step 1 gives us an 800,000 gross profit. So our estimate actually of $1 million now has changed to 800,000. And dividing the costs incurred to date against the total estimated cost, which actually went up, we are now at 75% completion. With 75% completion, our computed gross profit to date is 600,000. So in year 2, we now are going to recognize a total of 600,000 on this project. So when you look at step 4, in year 1, we did recognize 500,000 already. So for year 2, the only profit we are recognizing on this contract will be 100,000 because you've already recognized 500,000 in year 1. And as we continue on with the example, in year 3, again, this project seems to have been estimated wrong or something happened, but it is now costing us way more money than we anticipated. And for those of you that sat in the estimating webinar, you definitely heard pitfalls on how things like that may occur. So at this point, while the contract is still estimated to be $4 million, we've now incurred $4.2 million worth of expenses. And to date, our costs incurred through year 3 are now a total of $3.6 million. So when we go to compute gross profit for the completed contract in year 3, we still have our total contract sales of 400,000. And now our costs are 4.2, which means we are now operating at a loss. We're actually losing $200,000 now because we have 200,000 more in total costs just in this year. I mean, actually, it's a whole million in year 3. So when you look at this, because it's a loss, at this point, we can basically, for our own accounting purposes, look at this as we've incurred completion. We know the project isn't done, but for an accounting purpose, we are now operating at a loss. And because we're operating at a loss, we want to recognize that loss immediately. We don't have to wait until the end of the project to recognize the loss. Because as you can see under computed gross profit, our total contract gross profit is now a loss of $200,000. And so we want to recognize the full loss immediately. So when you look at step 4, in previous years, year 1 and year 2, we've today incurred $600,000 of profit is what we claim through our tax return. And because we had that $600,000, we are now claiming the full loss of $800,000 because this project is not holding a profit for us. So we are subtracting out the $200,000 loss with the $600,000 in profit that we incurred in year 1 and year 2 totals, and we are claiming a loss in year 3 of $800,000, which basically brings us back to having the loss of $200,000 as we had already claimed $600,000 the year before. So if you think about it from the tax perspective, what's happening is you're using the accrual method of accounting. You've paid the government taxes on revenue that was accrued as you're hitting the certain percentages for the completion of the contract. But when you recognize the loss, it's not a $200,000 loss in year 3. It was a total loss of $200,000 on the project as a whole. So you want to recognize the profit from the prior years as well as a loss. And so you're kind of backing that back out. So now in year 4, the final year of the contract, we've now completed the project in full. We've actually have an extra $100,000 in estimated costs. So our total gross profit on this project was a loss of $300,000. And so because we've recognized the prior 2 years of revenue and the $200,000 for year 3, we are only now recognizing the additional $100,000 as a loss for year 4. While it's complicated, the thing to understand here is that the laws determine that you immediately recognize it, while the profit was recognized in phases of the percent of completion. And when we look at the same figures for a project that is completed on a contract method, meaning the way most of you are operating, where your projects are done in 1 year, less than 12 months, you are now only recognizing the loss immediately in year 3. You would have never recognized anything against this contract in year 1 or 2 because the contract wasn't complete. However, because you're recognizing a loss in year 3, you would have immediately recognized the $200,000 loss in year 3 and then recognized the additional $100,000 in year 4. And if this contract were different and you have proved to actually have a profit, and let's just for the sake of math say the profit was only 100,000, you would have recognized it at the end of the contract in year 4 under the completed contract method. Now, definitely thank you for sitting through that, because this is definitely a portion of the presentation that works a lot better when you have the worksheet in front of you. So as we move on, we're going to talk about financial statements. And at this point in the presentation, I'm going to ask Victoria to please put up our third poll question.
It's up.
Perfect. Our third question reads, have you ever hired a CPA for an audit, review, or compilation engagement? Choice A is audit, choice B is review compilation, and choice C is neither.
they get quicker and quicker on the voting on these. I'm going to go ahead and share it now. All right. We have 33% said audit, 19% said review compilation, 48% said neither. I'll go ahead and take those results.
Well, thank you
Muted
so much
myself
for
as I
that.
was saying that. I took the results down. Thanks.
Thank you. So financial statements is definitely what the whole audit and review portion of accounting comes down to. Most of you may have been required to provide audited financial statements if you're a C Corp and have more than one shareholder. Additionally, it's very common for loan and financial institutions to ask you for audited or reviewed financial statements. It's my understanding that ODOT itself at times has requirements for at least reviewed financial statements. And so what we're going to do at this time is take the moment to kind of go over what these financial statements would show. And so the most common three financial statements are the balance sheet, which shows the assets, and they usually equal the liabilities and the owner's equity. An income statement, which a lot of people may also see and hear of it as a profit and loss statement, takes your total gross sales, subtracts your cost of goods sold, subtracts your operating costs, and usually end up with EBITDA. EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, is one of the factors that's looked at by the loan review and underwriters. It's also looked at by a potential buyer of your company. Some of you may be building a company and decide you want to sell it at some point. Someone who's trying to buy your company or an acquisition firm may want to know what are the actual earnings before you've had to account for taxes, depreciation, and amortization. As we know, the depreciation and amortization are two items that do not lower your actual cash, but they are additional expenses that you can claim for tax purposes, and it will lower the net income. And so because of that, they want to know how much money is actually available before you've actually accounted for those additional expenses. And then, of course, the statement of cash flows, which highlights operating, investing, and financing activities. Components of a balance sheet. As we stated, it's assets, which are categorized into current and fixed. Under current assets, you have your cash, marketable securities, accounts receivable, and prepaid expenses. Cash, marketable securities basically translate into those items that are fully liquid and can be liquid within 12 months. Fixed assets, on the other hand, are not as easily turned liquid, right? So you may have equipment, you may have land, you may have buildings, and while those things are asset, they're considered fixed because it would take you a little longer to turn that into cash. You'd have to go through a big sale process. But that's what makes up the current assets and fixed assets of a balance sheet. The lower half of the balance sheet talks about current liabilities, which are your accounts payable, your wages payable, short-term debt. Long-term liabilities, which are notes payable and pension liabilities. And then your equity, which are your owner's draws. For most of you, you're probably operating as a single member LLC or a partnership, which means that the money you pay yourself would be considered an owner's draw. And then you have your common and preferred stock for those who are set up as a C Corp and retained earnings. Something I want to point out is that under accrual accounting, prepaid expenses are carried as assets and expenses as utilized. So an example is you pay $1,200 for insurance that breaks down to $100 a month. The actual $100 expense is recognized monthly with a journal entry against the existing asset to lower the prepaid expense balance and recognize the expense. Under cash, you would have just expensed it as an insurance expense, as an insurance expense when you paid the initial $1,200. So I'm trying to jump between cash method and accrual method and give you an easy example just to understand that you're technically, while you may have technically paid for the insurance for the full year, it's not incurred until it's utilized, and most insurance plans are utilized over a set period of time. Additionally, discussing short-term debt, they're loans that will be paid within 1 year. Under current liabilities, you would also include a current year notes payable, which is basically the amount of the long-term debt that is due within that current year. And so if you think of that like a long-term debt that you may have on a mortgage of a building that you own, the amount that's going to be due in that 12 months on maybe a 20-year mortgage of this building would be considered a current liability, while the rest of it is still under notes payable and long-term liabilities. We now move into the components of an income statement. A lot of you may also recognize this as a profit and loss statement. The sections that first start off of an income statement are your gross sales, which is your project income and any other revenue line. Immediately, we are deducting the cost of goods sold, which most of the time are your materials, labor, equipment rentals, things that are only expensed because you needed to pay for that in order to provide the service or the product. So you wouldn't count administrative labor under cost of goods sold because that is an operating cost. So the cost of your admin, the cost of your accountant, the cost of your office rent would not fall under cost of goods sold because you're going to pay that no matter what, whether you have that project or not. But the materials that you had to purchase in order to provide the service, as well as the additional labor that you had to incur or bring on to the job, the subcontractors, so to speak, are considered cost of goods sold because you only provided that opportunity to them because of the project that you have. And then finally, you have your components of an income statement of operating expenses, which, as I mentioned, includes administrative salaries, utilities, rent, dues and subscriptions for any software you might be using, insurance costs, and liability insurance, not the bond. The bond may actually be associated to the cost of goods sold if you only got the bond because of the project. Car and truck expense, office supplies, professional services. So as I stated, your income statement is basically your profit and loss statement. It reports a company's financial performance over a period of time. And in my opinion, it actually gives you a clear picture of what is happening financially with your company. Preferably, you can take a moment to actually compare your projected income statement against what you are actually doing so you can get a better sense of what your monthly net income is and how it is being incurred. The final financial statement I'll discuss are components of a statement of cash flow. The cash flow statement summarizes the amounts of cash and cash equivalents entering and leaving a company. Those three activities would be considered operating activities, investing activities, and financing activities. Each of those activities would have a cash inflow and a cash outflow. Cash inflows from operating activities would include your revenue lines. Cash inflows from investing activities would include your interest income or dividend income. And cash inflows from financing activities would include loans that you obtain or maybe invoices that you factor. Cash outflows for operating activities would include payroll and material purchases, while cash outflows for investing activities would include capital expenditures, right? We discussed possibly making an investment into some equipment, as well as possibly a purchase of a bond, a government bond, a municipal bond. And then financing activities, the cash outflow would include interest expense that's earned on that loan that you have active, as well as any loan fees. So cash flow from investing activities displays how much money has been used in making investments during a specific period. It includes purchases of long-term assets such as property, plant, and equipment. Cash from financing activities shows the net cash flows of things that are used to fund the company, which could be financial activities that involve debt, equity, or payments of dividends. At this time, I'm going to ask Victoria to please put up our fourth and final poll question.
Up.
So the fourth question asks, how often do you review your projected budget versus your actual income and expense? Choice A is weekly, choice B is monthly, choice C is quarterly, and D, not often enough.
And Luis, I have to tell you, I made these so that they can pick more than one on this question.
Not a problem.
So they're voting, and we're almost to the percent we like to have, just to make sure we've got a good mix of answers in there. All right, we're there. I'm going to share the results. Weekly, they said 14%, 48% chose monthly, 24% chose quarterly, and 19% chose not often enough. I'll go ahead and hide those results, and it's all yours again.
Thank you, Victoria. Now, interestingly, I thought that I was going to get not often enough, choice D, as the biggest answer, especially because of everything that a lot of us may be going through with the current state of affairs on the COVID-19. But I definitely want to commend those that are looking at this on a weekly basis. And I say that because, to me, identifying and looking at your projected budget and reviewing it against what's actually happening is one of the biggest keys in making financial decisions based on what you see versus based on gut or versus impulse. So as we identify costs, on a project, of course, it's going to be such things as materials, labor, permits, design, professional fees, things like environmental cleanup, surveys, appraisals, equipment, and of course the indirect costs that we discussed earlier. And for those of you that actually participated in the estimating webinar, this is a crucial part of the process, as this will assist in determining your overall proposal. One key thing I would like to mention is that you should pay attention to your profit margins. When evaluating your final project budget, you should understand the percent of income that will be allocated to profit margin. How much of the overall revenue do you get to keep? I always advise any company I work with to have a set percentage they are comfortable with. Maybe it's 10% or 15% or even less, but having an idea of what percentage of the profit margin you are comfortable operating in will allow you to make the financial decision to pursue or accept an opportunity. You do not want to have to accept contracts that allow no wiggle room for unexpected expenses or no profitability. It's very important to have that set amount. We know that you're only operating with what's left over from your revenue after you've paid for your costs associated to that project. So what percent of that is going to be allocated to your operating expenses? So if your cost margins are low and you continue to accept projects that don't have a high percent of income available as your profit margin, you're not going to be able to keep up with your operating costs. As we continue to talk about this and more into day 2, we're going to hear and we're going to talk about cash flow and we're going to talk about forecasting. And so it starts with the actual submission of your proposal and your actual estimate. And you have to determine and come to grips on what percent is going to make a difference for your company. What can you not afford to go under? So if you're currently operating at 10% profit margin, what is the effect of accepting a job that only gives you 5% profit margin? And if that effect is going to be detrimental to your business, that may be a contract that you should probably consider walking away from instead of accepting. So crucial, very crucial to understanding the exact cost that you're going to have against that project, because you need to understand what's going to be left over to cover normal operations. Which brings me to planning for expenditures and a statement of expenditures. A statement of expenditures can be used on a monthly basis to show the position of a budget. The components of a statement of expenditures include the budget total, the expenses, and then the remaining budget. The expenditure budget is the portion of the company's overall budget that deals with the costs required to operate the business. What I've included here is a bit of a small template. I didn't give you a handout for it. It's something that's easily made in a spreadsheet, even using a table and a Word doc. And it's what I call an expenditure timeline. So you want to take your months and you want to take every single operating expense. And you may have actually already done this if you have a budget. And when you look at this expenditure timeline, questions that you want to ask yourself and you want to think about are what are going to be your biggest expenses in order to grow? Which expense is most important? And at what point in the year will you spend the dollars? Planning, forecasting are the basics of financial management. Reviewing your actual revenue and expenses against your project budget or expenditure budget allow you to understand if cash is going to be short during a particular time or when you will see an abundance of available cash. It allows for the proper timing of adding staff or making a decision to invest. It's also going to show how long your company could survive during unexpected emergencies, such as the one we're experiencing right now. A lot of you may have had to really look at this expenditure timeline without even thinking about it, especially if you were trying to apply for emergency loan funds, such as the Payroll Protection Program. I assisted several people who had to show what their owner's pay was or what their employees' pay was or their independent contractors' pay was. So that required them to go back and look at the actuals for 2019 or actuals for an 8-week period covering anything from January through March. They had to come back to some kind of an expenditure timeline, whether it was in your income statement, whether it was in your projected budget, whether it was in your projected profit and loss sheet. Because you had to understand what payroll costs you were going to have. right? You're carrying some administrative people who are on salary and must be paid during whether they're working or not. And then you're carrying some people who will only be paid when they work. But if you're going after any of these loan funds, they're requiring that you account for these expenditures, because you have to know what it's going to be forgivable. Meaning forgivable, 75% of these loans are forgivable based on just the payroll. So if you don't have a budget, an expenditure timeline to understand how much you need to cover during this particular period, you wouldn't be able to determine if your loan you receive may be completely forgivable. And so that's the importance of having these budgets. Again, when is it the best time to make that investment that you want into a new piece of equipment or adding that new staff in order for you to grow your business and be able to obtain more work? These are all questions that are only answered by proper review of your budget against your actual income expenses. And whether you're doing it weekly, monthly, or quarterly, I'll commend you because at least you're doing it. A lot of small businesses don't review what's happening with their business and operate on a whim. I never find it to be a smart move if you as the owner are only paying yourself based on what is left in the bank account on a monthly basis. If you're paying your own salary based on how much income was left over, you are probably not charging the right price for your service. And your estimates and your proposal are off. You should definitely be accounting for your own salary as part of operations. And you should know how much in total you need to cover operating expenses on a monthly basis. As we conclude day one, I've also included a resource in the handouts from the IRS, which is publication 3780, which gives tax information for small construction companies. I also know there is a survey at the end of the webinar, which I appreciate if you all take a little bit of time to fill out. I want to thank all of you for participating, and I'm now going to turn it back over to Victoria for any closing comments or any questions that may have popped up.
Thank you, Luis. There aren't any questions, so they must have just been soaking it all in, and I'm sure they'll have plenty of questions for you tomorrow. We do ask when I push the button to end the webinar in a minute that you please look for a survey that's going to open up on your computer, and if you could please complete that survey for us, we would greatly appreciate it. I do share those results with the presenters, and I want to make certain that they're able to get some feedback. So thank you so much, everyone. Stay safe, and we will see you on the webinar tomorrow, hopefully. Take care.